One of the things that prevents medical professionals from investing to build wealth is fear of losing money in the stock market. The last thing you want to do is spend your time going to work, seeing the patients, earn the money through all your hard work, and then subsequently lose it investing in the stock market. I'm Kristen Burton, the founder of Strive Coaching, where we help medical professionals convert their six-figure income into a seven-figure net worth. And I have personally lost over $25,000 in the stock market in a single day. So I know a little bit about volatility, and I'm here to talk to you about how you can overcome it even in a season like we're in right now. These are S&P 500 returns over the last week. Now, you see August 5th in particular, we had this big market downturn, and it may leave you wondering, what should I do, right? If I haven't started investing yet, is now a bad time to start? If I'm already investing and have been for a while, should I take money out of equities and go to cash? If I'm making consistent contributions, should I pause them? Well, this is a perfect time to look at the adage, when in doubt, zoom it out, and think about the big picture from a stock market standpoint. These are S&P 500 returns over the last 12 months. You can see all of a sudden, this downward slump we see at the end looks less problematic when we see substantial growth and strongly positive returns. This might make you feel better about investing currently, but what will help you feel the most confident is looking at the long-term results of investing in the stock market. These are S&P 500 returns since inception, and you can see that they've been very strongly positive, right? We see this slow walk up the mountain, and although there are ebbs and flows and dips in the stock market, you see that the result will create substantial wealth over long periods of time. We see times like this, 0809, right? Very difficult time to invest. We see this huge slump in March of 2020 when chaos ensued as the pandemic began. And if you invested through that, you felt that, right? It was a trying time. But when you look at the big picture, it becomes a blip. And you see that over the long term, investing in the stock market is likely to yield positive returns. There's three key ways you can mitigate your risk of loss in the stock market. One of which is to evaluate your holding period. The other is to dollar cost average, and the third is to really have an eye on your asset allocation. Let's first talk about holding period and what that looks like. Now, if you're a day trader, you're trying to buy a stock, buy a fund, sell it quickly, and get a quick win, right? Quick returns, then stock market volatility looks different for you. And I'm not really talking to you. I'm talking to people, medical professionals who are looking to build wealth over the long term, over 10, 20, 30 years, and aren't looking for the get rich quick scheme or the fast returns, but instead are looking for steady returns over time. This is information from the S&P 500 index. And you see that when they looked at historical periods of time, the longer you're holding for, the more likely your return is positive. Okay? When you look at 1 year periods, you have about a 73% chance of positive returns, 27% chance of negative returns. When you increase it to 3 year periods, your risk of loss drops to 16%. 5 years, it goes to 12%. When you get to a 10-year holding period, the likelihood of you having positive returns increases to 94% with a 6% risk of negative return over the whole period. If you go to 15-year periods, since 1926, not one has resulted in a loss. So if you're 30 and you're investing to retire when you're 60 or 55, your holding period is decades, right? The likelihood of you having negative losses over that time horizon is extraordinarily low if you look at historical data. So that alone should make you feel more confident that investing is the right thing to do, especially if your holding period is long and you're in the wealth accumulation phase and not the spending phase of your wealth cycle, because the likelihood of loss, statistically speaking, is quite low. Now, what if you're someone who has this inclination of like, I want to go to cash, right? Everything is going poorly in the stock market. I want to pull my money out and go to cash or cash equivalents. This is from Morningstar. And this graph shows your returns if you stay invested for the whole year versus missing the best month. Now, there's data elsewhere that I didn't plug in today that shows that best days and worst days actually tend to come close together. So it's very difficult for you or I to ever know how far away a best day or a best month will be based on today, even if today's a really bad day. Regardless of the overall positive return years or the overall negative return years, the blue, your returns if you invest the whole year, are much higher than your returns in the maroon if you miss the best month. Even on these really bad years, right? Like you see this year right here, really bad year. The return is much less bad if you just stay invested the whole year. So staying the course is powerful, right? And statistically speaking, if you get out, you miss those best months, your long-term returns are going to massively suffer. This has been studied, and I think it was Fidelity that did the study that said, "Hey, of our different portfolios, what type of person does well over long periods of time?" And they found that it was actually deceased people because they weren't fiddling around with their portfolios. If you are someone who goes, "Oh my gosh, everything's horrible, the stock market's horrible, I'm going to go ahead and pull out," and then wait for things to get better, things do get better. You start doing a little bit of FOMO and you go back in. You're doing the opposite of good investing, right? We all know that good investing would inherently mean you would buy low and sell high. But if you let your emotions or the psychological factors of investing control your decision making, you create a situation where you're doing the opposite of good investing. And this is why using the approach of dollar cost averaging is a great mitigator for long term risk. What dollar cost averaging is saying I'm going to invest a fixed amount of money on fixed intervals, time intervals. And so every single week or every single other week, I'm going to invest money in the stock market, regardless of what's going on. When you do that, you end up investing your way through bear markets, through bull markets, and you're always buying. You're not pulling out, right? So you're missing the chance to quote miss the best months. And by taking that approach, you're likely to be in the market for the best months. You're also likely to take advantage of those really bad months when shares are, quote, on sale. This is from Vanguard, and it shows that bull market surges, right? Huge runs in the stock market tend to be, quote, longer and stronger than the bear markets that preceded them. Meaning, if you can stay the course through a bear market, the likelihood of you then being the recipient of the givings of a bull market on the back end are quite high and historically really outpaced those bear markets in terms of return. So remember that staying the course, continuing your dollar cost averaging plan, increasing your holding period, all of those things, not only do they allow you to mitigate some of the long term risk of investing, they also are actually pretty easy from a life standpoint and remove some of the emotion, right? If you set up an automated investing system where you have a dollar cost averaging plan and you're someone that can stays with that, stays the course, then you actually take the psychological burden off of your plate of feeling like you need to know what's going on in the stock market. The last piece is to keep an eye on your asset allocation. Now, this is an example portfolio. It's by no means personalized recommendation to what you should have in your portfolio. But in this example, made up numbers, you might have a US stock allocation, international stock allocation, a bond allocation, maybe even a REIT allocation. And by creating something that makes you feel comfortable from a risk management standpoint on the front end and having that as your framework with what you're going to stick with over time, again, you can remove some of your emotional inclinations from the equation. So, for example, if you decided this was going to be your asset allocation, you wouldn't necessarily freak out when US stocks decline and move everything to bonds because you've already decided that this is your asset allocation. So, all you would do is maybe on an annual or biannual basis, you would rebalance your portfolio, right? Again, we're trying to take the emotions out of investing and create a consistent plan that's going to work over the long term. The other thing to consider is your broader asset allocation of all of your income producing assets. Maybe you are a private equity investor. Maybe you hold physical properties as investment property, right? Not talking about a primary residence here, that's a use asset. I'm talking about income producing assets. Having that big picture of what is my broad asset allocation is another way to help keep in mind what it looks like for publicly traded US equities to decline, for example, within the broader picture of your very diversified portfolio of income producing assets. Now, if you watch this and you're wondering how to actually create that automated investing system I keep talking about, click the link below this video to get my free training for medical professionals who also have student loan debt.